Okay, great. We will begin in just another minute.
Awesome.
Okay, the time is up. So, welcome everyone to the second masterclass live session of Coincall Academy. I'm Renee, your host for today. I'm from the Coincall team. So, before we get started, let me give a brief introduction about Coincall. So, Coincall is a crypto exchange providing financial derivatives trading. Our team members are from top exchanges and market making firms like Binance, JP Morgan, Optiver, and UBS. With over 9 years of professional trading experience in the crypto industry, the team observes the potential in the options trading market. We aim to develop a user-friendly platform as Robinhood to simplify financial derivatives, making them accessible to all users is our mission. So at Coincall, we provide one-stop trading service, meaning for options and futures now. For asset security, we ensure funds are stored in third-party custody platforms. Although Coincall is still young now within the market, but we are going to have the spot market, mobile app versions, and portfolio margin features in the coming months. So please stay tuned for our updates. Options can be tricky and we all get it. So that's why we introduced the Coincall Academy right from the start. Now we are launching the Masterclass live sessions to make options trading less complicated for everyone. And also for the part that you've been waiting for, the giveaway rewards. So keep your eyes open for secret codes during the broadcast. It will be released at any time. Make sure to direct message the code to our official Twitter account at Coincall Global. The first 10 participants to do so will grab awesome free rewards. And that's not all because be sure to have your questions ready for the Q&A part. If our tutor, Chris, selects your questions, you will also get a prize. The final thing is that make sure to share the live session with your buddies. More viewers mean bigger rewards for our winners. And let's circle back to the theme of today's live session. I'm sure that many of you are feeling a bit uncertain about the current market and the strategies you are considering to adopt. I have to admit that I'm in the same boat. I'm totally unsure about how to approach trading at present. So we understand that when it comes to trading, there are always concerns. How do we approach the current market? How do we identify market signals? And how can we get profit under current situations? So these are the topics that we are discussing today. That's why we have Chris here. So Chris now is an option tutor at Coincall Academy with extensive trading experience and expertise. We invited him to share his exclusive insight on how to make the money in the low volatility market, hoping this session will bring a glimmer of trading inspiration to those of us who might be feeling a bit lost right now. So I'll hand over my mic to Chris now. Chris, it's your turn.
Awesome. Thanks for the introduction, Renee. So are the slides able to? I can't actually change the slides on my StreamYard. Am I able to present here?
Yes, you can.
It looks like I've chosen the slides to present, but I don't see the arrow to like move them. I'm present. Oh, here we go. All right, perfect.
Okay.
Yep, everything's good now. Cool. Awesome. Well, hi, everyone. So my name is Chris Newhouse. I'm a graduate from Georgia Tech, and I have previous experience on the market insights and trading side of Genesis Trading, as well as GSR. I was previously an OTC trader on GSR, focusing on the spot and derivatives markets. I've been, popping up on several different trading-related podcasts. If some of you have seen me, I've been quoted byline on Yahoo Finance, Bloomberg, CoinDesk, etc., just for market insights and market commentary. GSR and Genesis Trading were two large crypto-native institutions focusing on providing liquidity in the spot and options markets. In my free time, I've written educational content on the options side for paradigm trading as well as derivative exchange. And now I'm currently working on helping build out the Coincall Academy with Coincall. And I also write weekly market insights. I'm sure if you've seen the first two pop up on our Substack at Coincall, those are written by me. I'm an ambassador for two DeFi protocols, Panoptic and Vertex. If you're interested in crypto or DeFi, I'm sure you've heard of those as well. I'm a mentor for Outlier Ventures, one of the largest venture capital firms focusing on crypto and DeFi in Europe, as well as the co-founder of Infinity Labs. It's a DeFi consulting agency that I run, focused on helping provide insights, strategic value, as well as product feedback for DeFi agencies. So let's dive into the markets. On this next slide, so this is pretty much just price action, but we'll go ahead and just discuss the markets broadly overall, as well as if you have any questions or comments as well, feel free to ask in the comments and we can cover those at the end. This lecture is going to consist mainly of a market summary and analysis, as well as a discussion of a few different types of strategies that we can implement. The content might go by pretty quickly, but we've left a lot of time for questions. I always find the best way to learn is by asking these questions. So let's get into some of the markets. Trading activity since the end of June has been very range-bound, as we're all seeing. Almost every pump gets sold off immediately, and even looking at some of the largest gap-up days here in the chart, they've typically been followed by a sharp sell-off. It's evident in both the spot and derivatives flow that there's definitely some strong resistance around the local highs, those local highs being this 30,000, 31,000 range. As we've seen, I think literally yesterday and the day before, we popped up to around 30,300 and then, sharply sold back off to reverse. We recently have the CPI print. CPI is kind of a macroeconomic indicator that we are kind of using as traders to determine what's going on with inflation. Inflation has been a very large narrative for people to be trading in the macro sense and macro terms as well. So it's one of the more notable events that people like to trade. But as we can kind of see by the price action today, there wasn't really too much of a noticeable move. Kind of just, double checking here, but it really seems like there wasn't too much of a noticeable move in the crypto markets. Let's double check here as well. Like, where are we trading? Yeah, we're trading at 29,700. Not very much of a noticeable move in crypto markets. What I had thought was going to happen, if there was kind of any sort of fuel to the fire of this macroeconomic event, the CPI print coming out, we'd see kind of the levels we hit yesterday, a little bit more supported, but, still trading below the 30,000 level. Volatility continues to decline. And even small pops in the front end of the curve are almost immediately sold off. Higher spot prices aren't really the only thing that are quickly faded by traders. Volatility is as well. If you take a look at the BVIV and EVIV indexes by Volmex, you'll see that, the subsequent front pop that happened over the past couple of days has already quickly sold off. I think it's down 5% today. And what this is, BVIV and EVIV are very similar to the VIX for the S&P indices and things along those lines. The methodology is very much so the same. This is kind of just getting a broad overview and kind of it's what I throw in the market insights and commentaries as well. It's kind of a broad overview of what's going on in the volatility or implied volatility for options. So whenever it's high, implied volatility for options overall generally is pretty high. When it's low, it's pretty low. So from a trading perspective, one of the most meaningful catalysts in my eyes is specifically focused on the spot ETF and any subsequent delays or approvals. I'm sure we've all seen the news over the past, couple of weeks, as well as a few days of the BlackRock spot ETF filing, as well as the subsequent ETF liquidity providers filing for theirs as well, Valkyrie and all the other ones. I think that this is probably one of the biggest events for crypto, other than maybe the Bitcoin halving in 2024, maybe some of the macro events as well. But recently, from a market standpoint, it really seems like the crypto markets are a little bit more focused on some of these esoteric crypto events, such as the spot ETF approval, rather than what we're seeing in the macro. And I mean, the CPI print today kind of supports that as well. We didn't really see a massive move at all, either towards the upside or downside for Bitcoin. And I think that we're kind of capped out here, not financial advice, but I think we're kind of capped out here at this 30,000 level right now until we see any more movement in that ETF delay or approval. Even with some of the macro events like the FOMC, over the past couple of weeks or, last month, as well as the previous CPIs weren't really meaningful in any way. Any upside speculation in the options markets for higher volatility post-event usually quickly fades. Like I said, we had CPI coming up this week. It's already happened. But based on what's been happening previously and how strong the range has been, it wasn't really a noticeable event for me. There's some interesting, DeFi and token specific ecosystem events that are taking place, such as the price action of tokens like YGG. It's the Yield Guild Gaming token that I'm sure a lot of people saw at one point. YGG, the spot market, was trading at 30% higher than the perpetual futures markets, as well as some events that had potential for widespread impacts, such as what was happening in CRV in the Curve ecosystem. We know that the impact the spot ETF filing had as well. It kicked us out of the local lows in June. But I personally think we've seen, the most we'll see out of the spot ETF as a catalyst for now until an approval or delay comes in the following months. Talking a little bit more about the perpetual markets, funding rates in the perp markets have been, positive for quite some time as traders took leverage bets to the upside and are currently paying out shorts. But with such a tight trading range on the dollar value of the dollar value of the single day liquidations hasn't really compared to what we've seen in June. This is all stuff that I think I also spoke about on the Substack, but just giving it a little bit of an update. So this is kind of I use a website called Amber Data. They have a free kind of dashboard as well as a pro version, and they give a massive amount of data on all options analytics and all options data. It's probably one of the biggest things that I use. And one of the questions we'll probably have is, what do you actually watch whenever you're looking at the options markets? And I watch a ton of different dashboards on Amber Data derivatives. This one is popular block trades. So what a block trade is it's a large buying or selling position, usually probably above 100 or above 1,000 or above 500. You can actually filter here as well. But block trades are usually large trades placed by high net worth individuals or institutions, and being able to see what the big money, as you've probably heard on YouTube or on Google, what they're doing. Sometimes it can be pretty insightful because they're usually, whenever they're taking on these large bets, first of all, it's a large amount of dollar premium they're either spending or collecting or risking. And second of all, usually whenever you're putting up a lot of money like that, you want to make money, right? Not lose money. So usually the bets that they're making are, well informed by quantitative models, fundamental values, and what they think is, proper fair value for some of these options trades, things along those lines. So as we can kind of see, a lot of the block trades are in Bitcoin. Well, this is also only a Bitcoin specific chart, but just overall, as we can see, kind of a lot of the recent flows in the options markets have been focused on Bitcoin. A lot of the stuff executed on Paradigm, a lot of the stuff going on in the options markets has been really focused on, for Bitcoin, there's some longer dated stuff going on. I'm sure we've seen some of the 100K calls floating around for 2024 expiry, as well as some of the 40K calls in the December expiry. Those are probably one of the largest open interest strikes currently, floating around out there. But in the most recent past couple of days, we've seen some interest in the shorter dated 30 to 60 day expiry range, I'd say, and less than that as well. And that's why kind of the front end of the volatility term structure has kind of popped up as well. So the recent move is very, very Bitcoin led and very Bitcoin dominant, as we can kind of see. Like I said, I really think that it's focused around this Bitcoin spot ETF and any subsequent delays or approvals there. Let's dive right into some of the educational content here for Coincall. We'll talk a little bit more about the impact of volatility on pricing. We'll cover some of the different strategies as well that you can kind of leverage to use here in a range-bound market, or something that I would use as well. A lot of these you'll see are focused on spreads or some sort of spreads. As Spread Greg from session 1 kind of highlighted, spreads are a way to kind of reduce risk as you're buying and selling options simultaneously, right? If you go short these naked options, you have unlimited risk. And I cannot, I can't really say, go ahead and just go out there and naked short options and take on these unlimited risky positions. I can't really recommend that to beginners at all. So, pivoting off of what Spread Greg had said, initiating these spread type trades where you're simultaneously buying and selling one option to put on a single VOO, that's something that I'm a little bit more, comfortable recommending, and something I do myself in this range as well. So let's talk about implied volatility. So realize, the biggest takeaway here, we'll just cover, what realized versus implied is. You can Google like how to calculate it, things like that. There's, Excel spreadsheets. There's apps you can use on TradingView to just actually calculate a realized vol over 7 days, 30 days, things like that. But for our purpose, realized volatility is what the market is currently experiencing through the price action of these assets. Feel free, like I said, to Google this to understand more of the mathematical calculation. But for our purposes here, we pretty much only need to know that realized is what's currently being experienced by the price action in the market, and implied is what the options market is forecasting for future realized volatility. Simplistically, when implied volatility is lower than realized, that might present a good buying opportunity, simplistically, and vice versa. When implied volatility is higher than what realized volatility is, that might be a good sign to go short some options. Something else to talk about: when implied volatility is low, option premiums are low, right? So for anyone who's traded in the traditional markets and you saw these GameStop or Tesla call options, you would see that some of these 2 to 3% out of the money calls were massively elevated in premium terms. You'd be like, wow, why am I paying so much for only a 2 or 3% out of the money call? And then also subsequently, why is a 10% out of the money call also equally expensive? That's mainly due to implied volatility. Simplistically, implied volatility is a parameter in several pricing equations. I'm sure everyone's familiar, or at least you should be familiar and can Google the Black-Scholes equation. That's an options pricing equation that several people use to kind of convert an options price into an implied volatility and an implied volatility into an options price. Lower implied volatility leads to less extrinsic value in these options. So when options have less extrinsic value, lower options premiums. Simplistically, the lower implied volatility is, the better the time it is to buy from a price perspective. But there is also a reason the implied volatilities are low, right? This is the market's forecast for future volatility. If implied volatility is low, then that's probably because the market is forecasting low realized. So, whenever I was saying when implied volatility is low and realized is high, like that's a good time to buy, it can definitely deviate. So we can discuss a few different, and I'll give you a personal market view as well. So there's actually a great article by Greg Magadini he's the director of derivatives over at Amber Data, and he put out this article. And the article kind of covered traders having different styles, right? And this is something that you should think about as well, right? So some like to take profits and cut losses very quickly. They might be better suited to being a net seller of options. I like buying options, not really selling. I either hold big winners or I'm happy with letting the options expire worthless. I'm happy with reassessing the positions at different times. I'm more, I would say that my trading style is more suited towards, buying options. So in the current environment, I know this is, very focused on options. I'm pretty sure Coincall is launching perps and things along those lines, futures down the line. But in the current environment, I would actually probably rather use perps to just not have to think about betting on volatility or betting on theta. And I can just purely bet on the direction that the market is going. In markets like these, whenever we're very range bound, you need to be very quick to adapt to what the current situation is in the market. One of the definitive characteristics of range bound trading is that you're trading in a range. As soon as you hit the bottom of the range, you can easily go back up to the top. There's not very much follow through or momentum once you start hitting the tops or bottoms of these ranges. So being able to identify what range you're trading in, as well as some of these stronger like supports and resistances, can be very pivotal for you to change your position quickly. You need to be thinking on a swivel, being able to have a position, realize it's probably not going to win, or probably realize it's won as much as it can, and then flip your position. That's something that I think about whenever I'm actually trading some of these range-bound markets. However, there are definitely some option strategies you can use as well. Just another kind of note here: when realized implied volatilities are at historical lows, I kind of feel scared selling because I'm not sure how much lower we'll go. But then I'm also scared buying because I'm going to be sitting here bleeding theta waiting for something to happen in the markets. So for me, this is kind of like a double whammy position right now in this specific market where we're at low implied volatilities for options, which is great for option buyers. However, realized has also been historically at some of the lowest points it's been as well. So this seems to be like a new market regime and kind of a new trading environment for traders who are very familiar with these high volatility regimes and high volatility environments of crypto. This seems like a complete new one that I haven't really been able to trade yet. So from my perspective, like I said, I'd actually rather just take directional bets, whether that just be buying spot or, buying perps, selling perps, things along those lines, because then I don't have to worry about, theta and implied volatility and things along those lines directly. And I'm pretty sure Coincall is releasing futures and perps eventually. So this is here's one of the kind of strategies you could use. And what this strategy basically is betting on is the price staying above a certain level for a put credit spread or below a certain level for a call credit spread. And as you can see, this is kind of the payout diagram of a put credit spread. So for a put credit spread, you are selling a higher strike put and buying a lower strike put for protection. So this would be like selling the $95. Let's say we're trading at $100. This would be selling the 95 strike put and buying the 90 strike put for protection. As you'll see, all of these are spreads. Like I said, I can't really recommend, just selling naked options for beginner traders as your loss is kind of convex there and also uncapped. But like for these credit spread type positions and for these spread type positions, you'll realize it's literally just doing so what a credit spread is it's either just a naked call or a naked put, and you're buying some protection. So we're selling the 95 95 put here, and we're buying the 90 put for protection in case it goes even further down. Our losses are capped to $5 minus whatever credit we took in. And then for the iron condors that I'll cover next, you'll realize that is just 2 credit spreads. And why that works out, actually, I'll cover it once we get there. But yeah, this is a put credit spread. You can also subsequently form a call credit spread where you are selling the closer to the at the money call and buying a further out of the money call as protection. So in summary, whenever you're putting on these credit spreads, you are selling whatever is closer to at the money and buying the further out of the money just for protection. And as you do that, you'll see you'll always collect a credit. There shouldn't really be any opportunity for you to sell a closer to the at the money kind of option and buy a further out of the money for a debit. That it probably would never make sense. Maybe in DeFi when liquidity is kind of weird, but not in CeFi usually. So credit spread, like I said, it's betting on the market being above or below certain ranges at expiry. This can be bullish or bearish. So, a put credit spread, if we're selling the 95 strike put, we're wanting it to end up above 95 because we do not want it to be expired, or we don't want it to be exercised. And if you're selling a, 100 strike call, that's bearish because you want it to end up below 100. So spreads, like Spread Ready explained in episode 1, can cap our risk. But in my end, and like I've said multiple times, in my opinion, beginners should never sell the naked options. The losses are uncapped. So we can talk about iron condors next. This is a combination of 2 spreads. It's a put credit spread and a call credit spread. So you'll be like, for example, 100 strike, you will sell the 95 strike put, buy the 90 strike put for protection, take on a credit. And then on the upside, you will sell the, for example, 100 strike call, buy the 110 or 105 strike call. Something to talk about for, iron condors and butterflies. Usually the strikes are equidistant. So if it's 100, 95, so if you're at 100, the width of your credit spreads are going to be the same. Usually you can do like broken wing butterflies and a bunch of different things like that whenever you split up the strikes, but change the risk profile. But just for simplicity, here's the P&L of an iron condor. Like I said, it's 2 credit spreads. So it's pretty much a combination. Like I said, it's a range bound view on the market with a fixed risk, but with fixed risk comes with limited profits. And then, like I was saying, all these strategies are spreads. So this is actually just a strangle, but with protection. So if you were selling the 95 put and the 105 call, that's just a 95, 105 strangle, but we're buying some protection to cap our losses. By buying that protection, we're reducing the P&L that we can take in as well. One of the interesting things about these iron condors and butterflies, you can leg into the position separately and target certain ranges. So if we are trading at let's use an example for Bitcoin. If we're trading at the 30K region for Bitcoin, maybe we sell the 30K call, buy the 31K call there while we're at this upper end of the range and option premiums are inflated there. And then as we kind of, go down to the bottom of the range, let's say, 28K, we sell the 28K put and buy the 27K put and put on the put spread there. And we collect as much options premium as possible. If you think about it, the market cannot be in 2 places at once, right? You can't have the put spread be in the money as well as the call spread because the price has to be between those strikes, right? So from a perspective here on losses that you can face, the total loss is just going to be the difference between the strikes and the credit spread. So if your put is 90, 95, your maximum loss is going to be $5 minus however much credit you took in, right? The market cannot be at the call side as well. You can't lose anything there. So this is a little bit more, you can collect more premium doing this than just a simple credit spread because it's 2 credit spreads. But it also kind of, you have to be within this range because if it blows out of the range, you'll take the max loss of, width of the credit spread minus your premium. Butterflies are very similar to the iron condor, except you're trading a strangle instead of a straddle, and then buying protection there. So pretty much what this is you're betting on a specific price target, pretty much. You want it to end up as close to the short strikes as possible to collect the maximum amount of premium here. So it's similar to Condor, but it's even more of a narrow range. You're betting on finishing at a specific price target, but you're compensated more in credit to help when you're slightly wrong. It's similar to a straddle, but with protection. And then depending on volatility, directional bias, liquidity preferences, and risk tolerance, you can either choose the difference between butterfly, condor, credit spreads. But yeah, in summary, kind of what I would be trading right now, not financial advice. If you were, this is a very range-bound market, and it has been for the past 2 months. Like for me, it would be really interesting to be putting on longer dated, or it doesn't really matter. But I'd say maybe these October, December. Like I'd say maybe if the ETF catalyst is going to be in December, and we think that the market is going to be range-bound every way up until December, we could put on these iron condor spreads where we're maybe putting on a call credit spread around the 30K range. So yesterday would have been a great time to put on a call credit spread where we're selling the 30K call and buying the 32 or buying the 31 or something like that, collecting a credit. And then as we kind of move towards this bottom end of the range and we're trading at the 28.5, 29 levels, 27 levels, that's whenever I would be selling a 28K put, buying a 27K put, or selling a 29K put, buying a 28K put. Like I said, the cool thing about these iron condors is you can leg into them all at once if you want, but the best way to trade these and manage these is to kind of leg into them, leg into them at different times whenever your credit is maximized. So that's kind of a trade that I'd be putting on right now if I was interested in it. And if you wanted to get even less speculative on the range and you just think we're going to trade above 28K, you could just sell the put credit spread here. You could sell, let's say, a 28K put and buy a 27K put. And as long as we're above the 28K by the expiry, we're going to make money. And then we don't even have to worry if it breaks out. And then there's also a bunch of crazy strategies you could put on where you put on this credit spread and then you use the premium to buy calls. Like there's a bunch of different things we can do. And I'll be covering that in some of the advanced articles in Coincall Academy that will be coming out at the end of this month. But yeah, just a summary. Those are two strategies I'd be interested in right now. I'm not too overly bearish in the short term. So something interesting for me to put on would, like I said, maybe sell the 28K or 28.5 put, buy some 27Ks as protection for the put credit spread. Or if you're very confident that we will trade in this range, you can collect even more credit by putting on the iron condor, because like I said, instead of betting on it's just above a certain level, with the iron condor, you're betting it is in between 2 levels, which is a little bit more of a speculative bet on where we're going to be in price. And then I think we've got time for probably a decent bit of questions. I finished, 2 minutes early on the educational content side, but, happy to answer questions here. Oh,
yes, Chris, we can read the comments.
Got it.
And you can pick up the question.
Sure. Let's see. Someone said, will ETH, Andy RVD asked if ETH will move up or down. So I can't really recommend anything directly, but I do think that the current market environment points to Bitcoin being the main asset that people are taking a look on, because the stuff that they're speculating on is kind of this spot ETF approval. So that's something that I think is very interesting. I do think that the narrative for these next couple of months will be Bitcoin led. So ETH could definitely move up or down, but I do think that Bitcoin is going to be leading the way in terms of a percentage move. As you can kind of see, like Bitcoin right now is around this 29.5, 30,000 range. A couple of weeks ago, ETH at this similar levels for Bitcoin was at 2,000, and now it's significantly lagging. One of the things that you can take a look at on TradingView, as well as just Google it, there's this thing on TradingView called the ETH BTC ratio. I just typed in like ETH BTC and it's on Coinbase. If you take a look at that, the lower it is, the more Bitcoin dominated the market is, and the higher it is, the more ETH dominated it is. So if we take a look like early June, the ETH BTC ratio was around 0.07, 0.071. If we take a look at it now, it's 0.062. So it's, almost a 15%, 10 maybe a 10, 12% decrease since June, which means, Bitcoin has outperformed ETH since then, as we've seen in the implied volatility as well. It's a little bit more of a Bitcoin dominated market. JJ is asking, is the ETF hype already priced in? That is kind of what I was talking about early on. I was saying that kind of this ETF hype that we've seen established in June, I feel like it's already priced in, which is why I feel like we're already at these 30K levels, right? Whenever the ETF news came out, we were at 26. We've gone up 15, 18% since then. I think that 15 or 18% move was based on the ETF hype. However, I feel like the thing is, this is not a guaranteed approval. As much as people kind of like to think it is, there's always that small probability or small percent chance that stuff like what had happened earlier on where, the SEC had denied BlackRock and said, hey, you need to provide, more clarity on who the liquidity providers are going to be and how you're not going to be able to manipulate this, blah, blah, blah. And they did and quickly refiled it, et cetera. That's also why the market didn't move too much. But I do think that since this is not like a guaranteed event, 100% certainty, 100% chance, and there's always potentials for delays, ETF hype is priced in, sure. But what happens if the ETF is completely denied? Like, I feel like that is whenever volatility starts coming back into the market and we start seeing potential downside. So ETF hype already priced in. I'd probably agree with you there. The move from 26K to 30K is definitely kind of, pricing in some sort of ETF hype there. But I do think in the next, 60, 90 to 240 days, whatever, the deadline is, I think that there is maybe the small chance that it is not approved or it is delayed. And if it's delayed, that's going to be even more time for uncertainty. And that's whenever we're going to start seeing the markets start pricing in some different things as well. Sure. GZ Tay asked what range of implied volatility is considered low. So there's actually charts you can pull up depending on where you're trading. There's something called a volatility cone on Amber Data, and it will show you the 25th percentile, the 75th percentile, the median range for implied volatility across expiries and strikes. And right now, I'm pretty sure we're in like maybe the single digit percentiles for implied volatility. I haven't checked that. But there's also like if you're trading equities as well, and I'm sure multiple people are, there's things on Tasty Trade, the IB percentile. That's something that you can use. And relative standard is probably pretty subjective. Some people who are comfortable going long volatility in the 20th percentile might be waiting until it's the 5th percentile to be going long there. But yeah, for me, what range of implied volatility is considered low, and is there a standard? I'd take a look at the volatility cone. I'd take a look at, like I was talking about, those volatility percentiles and quartiles and things like that. And you can do that on Amber Data. You can do that on Tasty Trade or Tastyworks, that platform as well, for equities, maybe also crypto. And then for me, like we're trading in the single digit percentile range for implied volatilities right now. That's pretty low to me. But like I said, for me, this seems like a very new volatility regime in which implied volatility is massively low, but it's low for a reason. Realized is very, very low as well and has continued to decline. And I don't really see too many short-term catalysts that are going to prop that up. Yeah. Muth Harasan ASFA had asked, can techniques in Forex be applied to crypto? So I actually do not trade Forex at all. The only thing I trade is crypto. The only thing I kind of have traded, I've traded some equity options in the past, but the only thing I really specifically focus on and have institutional experience in is trading crypto. So whenever I'm discussing these crypto options markets, at least it comes from a very strong point of, I have some professional experience there. Haven't really traded Forex. I've traded equities, but not in a professional capacity. So the strategies you use as a retail versus professional trader are pretty different. I think we have a lot of time actually. So one of the differences between some of the retail versus professional strategies are retail are more likely to be kind of buying these options, like I said, right? Usually the retail are the ones buying from the institutions. The institutions are selling. The institutions are kind of betting a little bit more that their pricing mechanisms are better and that they have a better view on implied volatility, that they're selling you these options for more than they're worth, waiting for it to expire, and then collecting credits there. Retail is a little bit more focused on buying options. But like I said, my favorite kind of strategy as a retail trader in my own personal account is to buy options. I like doing that. I have the personality and trading style, as I was talking about, that's a little bit more prone to, buying options. If they hit, it's going to be a 10, 100x. If they don't hit, I lose some premium. As a retail trader, I haven't really sold options too much. And once you start getting into selling options, I'll cover this in one of these Coincall Academy articles. Something you can do is dynamically delta hedge these options, which means rebalance the underlying exposure your position has to the market so that it's usually net neutral, net zero. And whenever you're doing that, you're really taking a pure bet on implied volatility and gamma rather than, focusing a little bit more on the market moves there. JJ asked, could you please share your most successful options trading experience? So this was in equity options. It happened over the course of 4 days, and it was during COVID. This was probably my biggest trade ever, over 4 days, and I had turned $300 into $250,000 in 4 days. And the way that I did this was specifically with options. Like I said, it was during COVID. So there's a lot of news, a lot of volatility, a lot of different things happening. Pretty much what had happened was we were pretty much at the bottom of the COVID range from what was going on. And, the US government was doing bailouts. It was doing, these payroll protection, like all this stuff. They're putting so much money in the economy. They just want to kickstart the economy. We couldn't fail, all this stuff. And what I was speculating on was, okay, well, what is one of the only things that they could do? They've done everything. What's one of the only things they haven't done? And it was kind of make the bet to backstop the small businesses, high yield credit, backstop those businesses and kind of prevent them from failing. So what I wanted to get exposure to was high yield corporate credit bonds. The small businesses, the medium-sized businesses. I thought, okay, what's the next step here? Well, I was reading on Reddit and kind of speculating and reading as well. Like, the thing that they haven't done was say that outright that they're going to put a backstop there. And I had done some Googling, and I had known that there was a high yield corporate credit ETF called HYG. And that's one of the interesting things about trading as well is when you're a beginner, this is specific for the equity markets because there's so many different things you can trade. Crypto is super easy. There's like Bitcoin, ETH, and all the altcoins. But for the equity markets, just knowing what the best liquid underlying asset is to express your view is a skill in and of itself for beginners. For all the sales and traders and all the professionals, they already know what all these are. But for me, I was like, okay, so what is the most liquid vehicle that I could put this market view on? And it was HYG was an ETF. It's a bond ETF. It's a bond ETF. It doesn't move. Bonds barely move like day to day. So I had bought, I remember HYG was at $79.41 and I had bought $81 calls. This was on a Thursday. So I had bought 1 day to expiry, $81 calls for $1 each. And this makes sense because it's a very low volatility bond index. Implied volatility was low, so the options were super cheap. It was out of the money, also super cheap. And it had 1 day to expiry, which means I either had to be right or wrong. Because if I was wrong, but also like if I was wrong, it was only $1 per option, right? And then, I wake up the next morning. This was one of the right place, right time with the right ticker and all the right strategy. I wake up the next morning, I turn on the news, and at 8:25 a.m., there's news saying that BlackRock is going to be, provided money by the Fed. I don't remember the specifics, but the TLDR was BlackRock and the U.S. government had said that they were just going to buy HYG, right? They were not going to let that bond ETF be impacted. They weren't going to let those businesses fail, things like that. I don't really understand too much of the technicals there. I just thought okay, small businesses don't fail, high yield credit, okay, HYG, blah blah blah. So there's probably a lot more story there, but it was pretty much they had straight up said BlackRock's going to buy HYG. And then, of course, knowing that backstop is there, people just started buying that bond ETF back up because they realized okay, this isn't going to fail. We can get back into this. And HYG went from $79.42 to $83 in the next morning. As you guys know, the difference whenever you are, trading just naked calls, difference in P&L is just going to be, whatever the spot price, the spot price minus the strike or whatever for your calls. So each of the calls that I had bought for $1, I bought 200 of these. Each of these calls I bought for $1 these were now worth, $200, $300 each. So I sold them at open and turned, $200 into 60K. And that was in one day overnight. And then once that had kind of kicked in and started happening, like, it's a very retail mentality, very degen mentality, to be thinking that you're playing with house money. But once I had turned $200 into 60K, I was ready to take some pretty, speculative bets as well. And this was right at the bottom of COVID. I think Tesla had earnings kind of coming out soon, or Tesla was a very interesting stock, or Tesla was trading in a certain range. And I just bought I spent like 40K and put 10% out of the money, weeklies or weeklies or 2 week to expiry calls on Tesla. Those ended up hitting, and that was like a 4x. So 40K to 160 plus, whatever I had made ends up being around 250. And that was over the course of 4 days. So that is an example of very low implied volatility, super cheap options, winning on both a directional bet and implied volatility. Because right after, bond ETF, it doesn't move like that normally. Whenever it moves up 4 or 5% in a day, implied volatility of those options started going pretty crazy. So I had won on both a volatility perspective and I won on a directional perspective. And that's why I made so much money off that first trade. It was like a 30,000% return or something whenever I pulled up Robinhood. And then on the Tesla options, pretty sure I was just making like an earnings bet or something like that. And they ended up hitting earnings and making pretty decent money there. But yeah, that was my most successful trade. Kim L had asked, which options trading strategy do you think should be best? I kind of covered this a little bit more. I kind of like I actually would rather just trade direction with perps, but the one that I did, suggest was the Iron Condor. We're trading very range bound right now. So one of the things you can kind of do with the Iron Condor is, like I said, you can put on the call credit spread around 30K, put on the put credit spread around 28K and capture the credit there. So that one's pretty easy. We covered it in the slides. Levi asked, for managing multiple position combinations can be challenging. Do you have any simpler strategies and suggestions? So if you're saying the Iron Condor, Iron Butterfly, and even the credit spreads are too challenging, then I would just say I would not be like I would say that I would just trade perps then. If you can't, like the Iron Condor, the cool thing about it is it's just 2 credit spreads. So it's pretty easy to understand. And the cool thing about the credit spreads and things like that are you only have to have, depending on your broker, you only have to have enough collateral to cover the loss. You don't have to have like you don't have to think about margin. You don't have to think about any of that. I know for some of these brokers. So I would say, like, if that's what you're saying, then maybe just stick to perps. But if you're saying like, okay, I have 8 or 9 different positions on, and now I want to put on this Iron Condor, how do I manage this Iron Condor as well as my 8 or 9 positions? Then that's a different question. And I would say that whenever you have stuff like that, you really need to be thinking about each trade as an individual bet. So if you have conflicting bets there, then that's something that you should definitely assess. Probably just don't put on the opposing bet unless you think that the bet is no longer good, things like that. So in summary, for retail investors who have multiple positions, or if you find these multi-legged option strategies complicated, then, instead of focusing on simpler strategies, I would focus on learning a little bit more about how to manage the complicated situations. And that's what we'll cover in the Coincall Academy as well. I'll be putting out some articles, and I think there are already some articles there on straddles and spreads, things like that. Elizabeth had asked, where are the smart money? I think this is kind of inquiring towards what is big money doing right now. And like we were talking about in the markets commentary and market color, we were discussing, where are the big block flows going? And, just from what we were seeing in the market color there earlier on in the, past couple of days, it looked like a lot of people were buying short dated, out of the money calls for Bitcoin, which means they're taking bullish bets. And that was 1 or 2 days ago. But as we can kind of see right now, those aren't really playing out. So, just because someone's putting on a ton of premium for a big trade doesn't necessarily mean they're going to be right. It could just mean they're taking on, just a bet in larger size than we could put on because they have a lot of money. 1 million to them might be 1% of their bankroll, or, maybe not bankroll, but portfolio. And then, 1% to us might be 1,000. So just because their bet is larger in size doesn't mean they're going to be right. I mean, the past couple of days, people were putting on these 32K calls out of the money, Bitcoin calls. They didn't really pay off. They're probably losing a good bit of money right now. So like from this question, the main takeaway is just because they're putting on big size and can be classified as big money doesn't necessarily mean they're going to be right. However, sometimes there's things that happen and they are right. When should we buy in the money, at the money, and out of the money options? Typically, you're probably not really, I don't really know very many people who buy in the money options. Usually a lot of the liquidity and a lot of the speculation is concentrated on at the money and out of the money options. And it's for specific reasons that we'll cover in Coincall Academy. Actually, these articles might be going out pretty soon or towards the end of the month. But at the money options, that's where a lot of your Vega is concentrated. That's where the most impact of a change in implied volatility is going to change the price of your options. And those are usually the most liquid. If you Google it, I'm pretty sure like at the money and out of the money, those are probably the most liquid options because you have two different types of flow there. You have the people who are betting on volatility and people who are kind of trading these at the money options, trading strangles, straddles, or trading straddles, just taking a pure mega bet at the money straddles. And then you have kind of the speculators or you have two different flows here. You have the people who are selling the out of the money options to the people who are buying them, of course. You have the people who are selling the out of the money options to generate a yield. Here in crypto and here in Bitcoin specifically, there are people who will sell the out of the money calls just to generate yield because they don't think it's going to go above 32K. But if it does, they're happy to sell. So you have a lot of flow in there. You don't really have natural flow of people selling in the money options or buying them. I feel like I don't really see that at all. But you do have people selling the out of the money options to generate yield. And the people who are buying those are speculators. You have the people who are buying and selling the at the monies because those are, where most of the Vega is concentrated to bet on volatility. So at the money and out of the money, definitely different reasons there. Gave you some examples there. If you're buying out of the money, you're probably speculating. If you're buying at the money, maybe you're also speculating because that's also where, Gamma and Vega are most concentrated. But depends on what kind of trader you are, institutional, retail. If you're wanting to speculate and get leverage, out of the money options are probably the move. But if you want to purely be exposed to a little bit more of, a change in intrinsic value, at the monies are pretty good as well. Mike Wilson at 1028 asks, can we trade with low assets and get profits? So options, as the story I just gave you, turning 300 into a very large amount, yes, you can, but the ways that you're going to do it are probably some of the most risky ways possible. So like I said, in that story and in that example, I took this bond ETF that had never moved that percent ever. Or it probably did like early on, but I probably wasn't even like in high school. It probably has. But the bond ETF like needed to move 5% whenever the market was pricing in, like it can only move at 1%, in a day. And I had taken that bet that it moves 5% in a day. Well, I had taken the bet that it moves 5%. And then I had, compounded on top of it. It does it in one day. And that's how I made like a decent bit of profit there. You can trade with low assets and get profits and not do crazy risky stuff like I did by trading spreads, kind of like spread Greg had talked about and kind of how I talked about here. So if you've got and it depends on what you mean by low assets. Like if you don't even have 500, then probably don't get involved in options because the only option strategies you'll be exposed to are short dated out of the money. And that's kind of just a lottery ticket. That's just gambling. So options, if you got lower than a certain amount, probably not for you because you're only going to be exposed to strategies that over the long term are probably going to hurt you because you're taking a bet on being right directionally and also being right in a short amount of time. Nobody can predict the market. One of the things that you can do though is perps, perpetual futures on some of these decentralized exchanges and maybe Coincall as well, is trade perps. Because you can put up money there and put in a small order of Bitcoin, but it's also like whenever you're trading perps, it depends on how much leverage you want to use, things like that. Basically, you will probably never ever get rich quick with low assets unless you're taking very, very risky trades, and that makes sense, right? Risk reward, things like that.
Yeah, I think we have, or sorry to interrupt, I think we have enough questions for the Q&A part.
Awesome.
Yes. Yeah, I think. So huge thanks to Chris for the amazing speech today. So it's truly inspiring stuff. I'm sure we are all leaving today with some fresh market insights. And for those whose questions got picked earlier, remember to message our Twitter account with your email addresses, or you can contact our admins of official Telegram group within 3 days to claim your rewards. So once again, thank you guys for joining us today. So we look forward to seeing you in our future events. Don't forget to follow our Coincall account and Chris on social media for more updates. If you have any more questions about options or trading, don't hesitate to contact us. We are always here. So that's that's all for today. So see ya, guys. Have a great day. Bye bye. Thank you, Chris.
Bye.
Bye.